What's going on? Ed here from ClicksGeek, and I am with my buddy Jeff. And Jeff is one of the largest hard money lenders in the Midwest. And we're in a mastermind together for buying businesses. And we got to chatting about hard money, which is his main business. And I said, Jeff, you should come on our channel because we have a big audience of real estate investors that we have as clients and that follow our channel. And I thought it would be great to have you on and just pick your brain. So welcome to the show, Jeff.
Hey, thanks for having me. And God help everybody that's watching because, when you get to see the cobwebs, it can get a little scary. So you just never know where this will go.
Awesome. All right. So Jeff, for the uninitiated, what is hard money exactly?
So hard money is, it's a kind of lending that most people completely misunderstand. Usually when people hear the words hard money, they start thinking loan shark, the guy that's walking down the street with a baseball bat that's going to bust kneecaps, which I bring those up because I was actually just at one of the RIAs in the southern part of Wisconsin teaching. And of course, I asked the audience, what do you think of when you hear the words hard money? And those were the two first answers that the crowd gave. And, of course, it was kind of funny because it's not even close to true. But hard money is really just asset-based lending.
Okay.
That's how it got its name. So the word hard comes from hard assets. That means it's really based around the property primarily. That doesn't mean people don't matter or anything like that at all, but that it originates around, is the deal a good deal?
Got it. Okay. All right. And you said something there that I like. You said it's not about the person, it's about the property.
Yeah.
You also have an approach where it's heavily about the person as well, and the credibility of that person. Talk me through your process on how you pick who you're going to lend to.
Well, so the truth is, every single lender, whether they admit it or not, is actually fairly heavy on the person. If a borrower calls up any hard money lender and the entire conversation involves the word I, like if I'm the borrower and I say, I'm going to make this much money and I'm going to do this and I'm going to do that, and it's all about it's usually a red flag to the lender.
Okay.
And the reason is because most lenders are really trying to be your financial partner. Now, most of us, we're not all the same. Some of us take that word financial partner a whole lot different than others. Some are just in it to be a silent partner where, our job is to give you the money, you do the job, you give it back to us, and we don't want to talk to you, we don't want to hear from you, we don't even want to know about the project. All the way to people that are actually closer to the way that we like to do it. We really want to be a resource from cradle to grave on the project. And that's why people matter. Because if I'm going to take some of our hard-earned money and stick it into your project, to me, the person is actually more important than the property itself. Obviously, it's got to be a good deal. But in the 15 years I've been as a lender, and I've been a real estate investor for 20, in that 15 years as lending, what I've learned is, unfortunately, there are what I'm just going to call crap. Some people are just crappy borrowers. And what I mean by that is they're disorganized. It's not that they're bad people. It's just they're disorganized. They don't really know how to run and manage crews, right? They don't know how to manage the projects. People that don't really know what they're doing really need to bring in partners. And when the skill set is kind of low, um, even with the best of intentions and the best project in the entire world, the odds are really high that they'll screw it up and make some mistakes. And the borrower won't make as much money as they think they're going to make. And that's a problem because, I understand marketing fairly well. I mean, I'm not a marketer, but I understand all the core concepts of it. And I don't want to have to go and hunt down borrowers all the time and constantly get new people. I really want to create that relationship and do repeat business with people. That's why we take the approach that we do, because I'm looking to just continue to do business with people over and over. Helps me keep my costs down. It helps save them money. Also helps make for better projects. People stay in business longer, right? You create that symbiotic relationship by working the people angle instead of just the property.
Got it. Okay. You mentioned being a resource for the borrower, partnering with them on a deal, or partnering with them in general, and your experience in the industry. Walk through what that looks like. Being a resource, is it just ask Jeff random questions, or is it deal in particular? Walk through what that actually means when you say be a resource for your partners.
Yeah, so it's a really really broad answer, unfortunately, and the reason that it's a broad answer is because it really encompasses everything that you just said.
Got it.
The team is trying to, and myself included, we're trying to help negotiate deals. We're trying to help make sure that the deal structure in the first place is right. We're trying to make sure that paperwork and the closing itself is going to go without a hitch. A common thing we see all the time is the name of the entity that's actually buying the property. Simple mistake is not actually the real name of the entity that's buying it because there's a typo on the purchase and sale agreement. It's not intentional, but if the names don't match, legally it's not a good thing, right? To, the deal comes to us, we'll help uh, maybe adjust some numbers if we can help that way. If you need help finding contractors, we'll reach into the database and start asking people. We'll jump into Facebook groups with you. We'll start looking for referrals and references. If it's in an area that we've already done business, it gets a lot easier because we've written checks to a lot of contractors through the draw system.
Okay.
uh, to how to best sell that thing, how to list it, how to stage it, to how to pick the right agent. To do you need a referral to a really good long-term lender, right? I mean, it's the whole gamut. I mean, that's why I said before, we're really in this from cradle to grave.
Got it.
We're really looking for success for that borrower.
Got it. Because at the end of the day, it's all in your best interest as well. It's all.
Correct. It's as much in the borrower's best interest as it is mine.
Mhm.
And so, we've had borrowers look at us and go, "Yeah, but you just do that because you guys make more money." But so do you.
Right.
So that's the goal, is to help everybody do better in the deal.
Sure. That makes sense. Okay. Walk me through the life cycle of a potential deal. So let's say I call up, I'm Ed, I've got a potential deal. I'm about to lock up in a contract, and I think I need X, Y, and Z to get this thing wrong. Just walk me through what this process looks like from start to finish till I'm back on the market, relisted again.
Sure. So obviously you've got a deal and it gets submitted to us. And it doesn't necessarily matter if it's under contract or not yet, although honestly, we do prefer that they're under contract.
Sure.
Um, but assume that it is under contract. So first thing we do is we do a deal analysis. Now, we mentioned that we look at people too. We're analyzing the people simultaneously while we analyze the deal, right? Because that's where the conversations are happening. That's where we start asking, what are you going to do with it? What's the plan? Have you run comps? How did you figure out the numbers? Right. So we're essentially trying to figure out what you know. That's really what every lender does. We're trying to figure out what you know and why you think this is a really good deal. And so we'll run an analysis with you. Now, we do an analysis that's a little bit deeper than I think the average person even goes, because in addition to just looking at things like points and interest, like most borrowers do, we'll actually start looking at your carrying costs. We'll start looking at the sales commissions on the backside, right? We start looking at all of it to the end of the project, and we'll help you figure out what you're really going to make. Now, that's important to know, because if you haven't taken into account certain expenses, you're not going to make what you think you're going to make, and it may not be a good deal to you if you knew the whole story, right? And those profits matter too, because what if contractors start giving you a hard time in the middle of the project and they blow you off for a week or two? Well, every single day you have that project, it's costing you money. So that's part of the whole onboarding thing too, as we talk about cost per day, right? In doing the deal analysis, so that you understand that if a contractor says, no, I can't come, and they say they can't come for, say, 14 days, and let's just pick a nice easy number, it's $200 a day. And that $200 is not hard to hit when you look at interest, taxes, insurance, utilities, right? All the things that are racking up while you got it. $200 times 14 days is $2,800. Guess where the $2,800 comes from?
Yep.
Doesn't come from the draws, doesn't come from the purchase price. It comes from your profit on the back end, right? So our job is to help you do a deeper dive into the analysis and make sure that it really is a good fit, not just for us, but for you as well. And then once we get that thing to the closing table, right? We work with the title company to make that happen. Once that thing's done, you take off running like a banshee. And our job is to help kind of guide and assist. Now, we like to have pictures and videos sent to us throughout the project so that we can help document that. Now, we do it because we're trying to tell a story too, because as we raise capital to give loans, we want to talk about all the successes that our borrowers have. So we ask our borrowers to send us pictures and videos along the way because it also helps with the draw process. Sometimes we can even eliminate the need for an inspector to have to come out, which just delays the whole process of getting paid. So if we can use the pictures and videos to determine the work that's been done, we can reimburse a lot faster and issue funds to everybody, which everybody loves it when they get money quick. A couple of years ago, we got rid of checks to help speed up the process. Everything's done electronic. We do direct deposits into people's bank accounts now, which means the moment the money hits, it's spendable. No more holds on checks, no more US Postal Service losing it in the mail, right? Everything's designed to help speed things up because
Sure.
time is money, not just for us, but we're doing it to make sure that you're not wasting your time and that your contractors stay engaged and interested in your project. And the faster they get paid, the more favors that they're willing to do and the more attention that they will pay to what's going on with the deal, right? And then, if something happens and there's questions or whatever, we're here to be a resource and answer questions and help find the resources if possible. We can't find everything for everybody all the time, but we do our damnedest to try to be a resource. And then, hopefully it makes it to the end and it's either sold or refinanced. In
Got
some cases, we can help with the refi. In other cases, we'll help refer you to a lender that we know that has the right product for you. And, I don't typically charge a commission or collect anything extra for referrals. That's just part of the service. So if I refer you to somebody, you work it out, whatever it is, that's exactly what you pay. You don't have to worry about hidden stuff behind the scenes,
Got it.
which is not always the case with a lot of others out there.
Okay. Uh,
So,
Walk me through how many so I know guys that'll flip and they'll do one a quarter.
mhm,
I know guys that'll do five at a time.
yep.
Where do you see your client base being? Kind of somewhere in between the two of them, or do you guys have really super active flippers, or more mom and pop? Where do you guys typically fit?
So we've done everything from one. I think the most we've ever had with one borrower, I think, is 12 loans
Okay.
at one time. Um, Now, the number of loans, really, that goes back to people again,
Got
right?
it.
Because not everybody can do 12 projects at once. Now, everybody wants to do 12 projects because that means more money.
Yep.
But you got to have the right systems, you got to have the right crews. There's more to it than just, hey, I can negotiate like crazy. I'm really good at it and I can close.
Yep.
So I can buy these 12 houses. But if you can't manage them, you shouldn't have 12 houses,
Yep.
right? So we're all over the board really in what we'll do. Sometimes we have to place the money with multiple lenders to kind of help spread the risk around so that one lender doesn't have too much with one borrower at a time.
Sure.
A lot of borrowers out there will just cut you off. They've got a hard limit. I'll only give two loans or whatever it is. We'll just start moving things around to other people. And behind the scenes, we're 100% private. So all of our capital is private capital. None of it is institutional. None of it is Wall Street. None of it is lines of credit. None of it is the dangerous stuff that most borrowers don't know about how we run our businesses. I'm strictly raising capital for private people. and placing it into deals that make sense.
Got it. Okay. Jeff, you're in a risk mitigation business and preservation of capital business
Yep.
and return of capital to your investors. Walk me through how you think about margin of error. We talked about this last week on how juicy deals need to be in order for it to make sense to even
Yeah.
continue that conversation. Just walk me through your thinking on margin of error.
So generally speaking, I like to see a minimum of 20% for a profit margin.
Okay.
There's a lot of guys that'll run them on 10%. I don't get excited on a 10% margin deal. Now, there's some variations and some forgiveness in that number, right? Now, I say I like 20% because I want to know it's a solid deal that even if it gets screwed up, there's so much room that the borrower can recover, finish the thing, and get paid.
Got it.
Because if they get paid, we get paid,
Yep.
right? But when you convert the percentage into dollars, because that's ultimately what things are based on, right? If we're talking about $100,000 house, well, that's only a $20,000 margin.
Yep.
If you're talking about $1 million house, that's a $200,000 margin, right? Can you get a little bit more flexible and maybe go down to 150? Sure,
Yep.
it's a lot easier to understand the risk tolerances when you start looking at dollars in addition to percentages.
Got it.
And that's an important thing that the vast majority of investors, in my experience, even our capital investors that we use, they're just not used to looking at things in dollars and cents. Everybody's used to just looking at, well, what's the interest rate? What's the percentage, right? Points are a percentage, right? Everything's based on percentages. And so nobody really knows what the dollars are. So that's part of our risk analysis, is to actually convert to dollars, look at things from a dollars and cents standpoint, look at what's really at risk, and look at how much safety margin those extra dollars, give us in the deal. It gives us a little bit more flexibility to a point.
Got it. Okay. I'd say one of the things I've learned is that you're, unlike a lot of other lenders in the space, you'll actually give people reasons why you've turned them down for a loan. Walk
Yep.
me through, think of like the last two or three times you said no and a deal just didn't pencil out. Walk me through some of the reasons why a hard money loan would not be facilitated, if what those reasons look like.
So the first big one is lack of organization.
Okay.
Organization is really, really super easy to spot. When you apply for a loan, every borrower knows they have to provide documentation to back it up, right? Because we as lenders, we need to know your legal name and the address and the phone number, right? We have to have that stuff just to document things properly. It never ceases to amaze me how many borrowers who've done deals in the past have no idea what they need to turn in, or are just so disorganized with the data that we have to request it 15 times. If you make it too hard on us and we have to just work just to get information from you, we usually just decide to walk away because the money isn't worth it,
Yep.
right? So disorganization from borrowers is huge. Um, Next one would be bad comps. We get a lot of borrowers that come to us and they go get some comps, and they'll go to the realtor, which is great. I mean, that's supposed to be where we go. They'll go to a realtor, except they don't get a realtor who understands what we're doing. They just pick a realtor. And that realtor is used to trying to sell the biggest numbers possible so they can get listings. And so when you get realtors involved who really don't understand the real estate investment game, and that we're looking for a conservative number. Now, we're hoping for the bigger number in every case because that means more profit to the borrower. But you want to come in and look at your deals from a conservative standpoint. So we get comps sent to us as part of the deal analysis that the borrower does that are, honestly, they're delusional. They're 50,000, 100,000 higher than what reality is going to be. It usually kills the deal because they negotiated the purchase price based on these inflated numbers. And so when you put reality to it, it leads into the third one, which is they don't have enough money to put into the deals. right? And so when you screw up your comps and you screw up your analysis, it creates a situation where, under a good deal scenario, sure, you might have to put some money in, but relatively speaking, it's a lot smaller than a deal that's way out of whack. You might come and have to put 20 or 30,000 into a deal, bring a deal that's screwed up, and you could come with 75, 80, 100,000 to make it work
Got it.
because lenders have limits, right? So we can only lend up to, say 70% of whatever the value comes in at for that we determine, right? And if it's delusional, we just move your number down to what fits conservative, recalculate, and then all of a sudden the amount we can lend you is way less than you expected. And so the deal will die because the money just doesn't work anymore. It might still work for us because we lowered the LTV or lowered the valuations down, but it's not really a good deal.
Got it.
So it'll get kicked out for money reasons.
Got it. So for the latter two, not necessarily the disorganization piece, but the latter
Yep.
two, you said something last week that definitely resonated because I see this in our own agency when we turn down white label providers that come to
Yep.
us with different deals that we just know are not good fits. You basically described it as you helping them and a blessing to them, and not take it personally. We're helping you not get into a bad deal. So kind of walk
Right.
through what that looks like.
Well, so, as somebody who's been in the game for 20 years, over the years, I've gotten to know a lot of the gurus in the industry, and I love going to conferences and events, right? So, over the years, I've met those people. And in the beginning, I was just like every other real estate investor out there. I didn't know what I didn't know,
Mhm.
right? And then one day, one of those guys said to me, sometimes the best deal you'll ever do in your entire life is the one that you don't, right? And that resonated with me because I started back in 2004, right before the crash.
Mhm.
So I lived through the correction of 8, 9, 10, 11, 12, right? And I saw a lot of people that lost everything they had in doing it. And they were deals that when you really went back and looked at it, no one should have ever approved those things. The borrower, buyer should have never bought it, and the banks should have never lent on it. They were just bad deals. So I look at it as a service to the borrower to help look at it and try to put some common sense and some reason to it and make it something that's realistic, and I tend to just call it, being conservative. Because if you're not being conservative, when you're talking about investing money, you're actually being risky, right? You're just hoping that things go, well, that's not good. So we try to look at it from that conservative standpoint, walk through the deal with the borrower, figure out where things are off. If the pricing is just out of whack, we explain to them why we're reducing dollars, right? And I'll even work with them on the phone to say, listen, here's how you go back and negotiate. Like, here's the words that you need to do to go back to the seller and fix this thing. It doesn't mean the seller is going to give you what you want, but here's a good shot at getting it. Truth is, the majority of the time it doesn't work because as soon as a borrower agrees to, say, a $200,000 purchase price, and then you come back and say, well, I'm so sorry, the lender says it only works at 150. It's usually such a shock to the seller that the words almost don't matter anymore. They're just upset and they just want you to go away. And so the deal's dead. And that's why it's important for us to help teach people how to do these things so that they can do it right and not put themselves in a position where they start looking bad, because unfortunately reputation does precede us, and even though we may not know everybody out there, if Margaret, the seller, decides that we were doing her a disservice because we promised her one number and then came in the back door and we were trying to knock her down 50 grand on her price tag, she'll tell all of her friends. And if any of those guys were in trouble as well, instead of getting a positive review, you get a negative review. And there are deals that don't show up on your doorstep because of how you handled the one before. Right. And it's important for people to start realizing that, because real estate's not a one-sided transaction. It's usually about six. It's not even two-sided. It's not buyer seller. It's buyer, seller, lender, title company, real estate agent, insurance agent, right? There's all these people that we all get involved in it to help facilitate it. Most are just looking to make a commission or make their cut off the deal. Don't get me wrong, I like money just like anybody else, but I can't sleep at night if I help people make money, either dishonestly or if I put my commission first, right? Money's not my number one motivator. It's actually helping people. So I like to serve first. And I know that if I do a good job serving people and helping them facilitate the deals, money will just come in the end, right? And so the more people that I serve, the more money that they make. And that comes with that education and teaching and the resources of not just connections, but it's also knowledge that we're throwing on the table.
Absolutely. Okay. You mentioned the transaction there. Let's stick on that theme for a sec. Walk me through hard money used for transactional lending. Walk me through what that is, how that process works. Just give me some insight, some overview of what it is.
So transactional funding is really for wholesalers, right? They want to double close the deal.
Yep.
It's by far the simplest out there. It's a competitive spot to be in. There's pricing all over the board. There's lots of low offers out there that have all kinds of fees that aren't disclosed, right? So there's a lot of stuff you got to pay attention to. But the transaction itself is actually pretty easy. Wholesaler goes out, gets it under contract. Wholesaler takes the contract, gets a contract to buy the property as soon as they close it, right? So you
Okay.
got your A to B and then B to C. So you got two purchase and sale contracts. They will come to someone like me and say, well, I don't have any money, because that's what they're sold as part of the coaching and sales programs that they're sold, right? It takes no money, which
Hmm.
is true. You can come to people like me and we'll put up 100% of the cash. And that includes all the closing costs and whatever's required to get the deal done. So you can come to us. You just have to bring, normal documentation. I gotta know who you are, right? So I can document it. You just bring me both sets of contracts and hook me up with the title company, and we'll figure it out for you.
Okay.
And generally speaking, when I say we'll figure it out for you, we'll take the bull by the horns and actually handle the transaction for the most part. And so, other than just having to provide your entity docs so we know who the signer is, and give us your personal information, there's really almost nothing to it. We don't even underwrite the deals anymore. We've gotten really good at our processes back here, and we've to the point now that if you bring us two purchase and sale agreements and hook us up with the title company, we can get it done. No underwriting, no delays. Let's just, how fast can we work through it?
Got it. Speaking of that, how fast would it typically be? Just out of curiosity.
So in theory, it's possible to actually do it same day,
Okay.
right? So if you come in now, you got to come in like at 8, 9 in the morning in
Sure.
order to get it done that afternoon, because you also have problems with wires, because the federal wire, which is how we move money around from us to title companies, there's time limits to when the last minute we can send cash is. Um, but generally speaking, 2 days, next day, 2 days, 3 days. The biggest delay is actually the title company's schedule,
Got it.
right? And the borrower's just ability to give us those 3 or 4 things that we actually need. That's really it for the whole deal.
Got it. So in terms of transactional funding problems, are we talking timeframes, title company issues? Is there anything else that jumps out as potential problems in the transactional funding space?
Um, every once in a while, a disclosure issue comes in.
Okay.
Sometimes borrowers forget to disclose things properly to
Okay.
to their buyer. Not necessarily the end buyer, I should say, but they don't disclose properly to the seller.
Sure.
If a seller gets wind of what you're doing, every once in a while they can wreak havoc. Um, but that doesn't happen very often. That's pretty minimal.
Yep.
Usually, it's more the title company than anything.
Got it. Okay. All right. Now, staying on the transactional funding side of things, let's talk about commercial transactional funding, commercial bridge loans. Walk me through what that is, how that process works. Obviously, they're bigger deals, but just give me some overview of what that is, how that works.
So in the commercial space, you would think it would be different.
Hmm.
But the truth is, it's actually not.
Okay.
If we're going to do a transactional deal, like we were just working on one last week, guy got a commercial building under contract for 10 million. He found a buyer for 12 million. Got both contracts, A to B, created the B to C, and brought us the deal. It's exactly the same process, whether it's a single family house that's worth 50 grand or it's a commercial building worth 10 million, 50 million. Like it doesn't make a difference. The process is the same, the underwriting is the same. Again, it falls back to the title company. Can they get us on the schedule quickly? And usually they're pretty accommodating because there's not a lot to do for them. It's mostly just witnessing signatures. That's the primary bulk of it. There's no mortgages and notes that got to get dealt with. Closing statements are super basic. Um, so it doesn't really matter if it's a house or I don't know, Mall of America in theory, right? The biggest mall in the United, like it doesn't make a difference.
Got it. Okay. Let's circle back to the residential side of things. So, if you are thinking about hard money loan paperwork and documentation, what's some stuff that you've kind of briefly covered it, but what's some stuff that they need to put together to have their ducks in a row before they reach out to Jeff and say, this is what I've got, so they can be prepared and organized, so that at least they're checking box number one off on Jeff's
Yeah.
no-go list.
Yeah. So, the majority of it is like if anybody would just sit and think about it, it,
Mhm.
it would it would be super obvious, right? Who are you? Like,
Okay.
you need to know who you are. If you're buying in an entity, I need to see the entity because the entity itself says the rules for signing. The reason we want to see the entity for the rules of signing is if you have a business partner and your operating agreement says that you both must sign,
Got it.
then we have to structure the closing where you guys both sign. Unless, now there's one exception to the rule, and that's when you guys put together, a nice letter from the other, person who's part of the entity authorizing you to sign by yourself,
Got it.
right? So, but generally speaking, that's what we're looking for. We also look for that stuff because guess who else asks for it? The title company, because they're looking for the same things. So we try to be real proactive in gathering that stuff because then we can just forward it to the title company. You as the borrower only have to do it once instead of sending it to two and three different places. Just send it to us. We'll get it to everybody else.
Okay.
Um, obviously we need to see the purchase and sale agreement. If this is going to be any kind of renovations, we need to see your scope of work. We need to know exactly what you're going to do to it. We need to figure out what comps did you use? How did you come up with your valuations? Right? I mean, we're really just saying, okay, just show me what you figured out. Like, show me the deal. Why do you think this is a good deal? That's not the ultimate decision making process, but it is a big indicator for us because then we can tell how good you are at analyzing the deals and making it a reality. And sometimes we can use that information to help with, say, appraisals or anything else that's got to get done. Not that we can influence things completely, but sometimes we can provide it and say, hey, we've done some research ourselves. We think that these are good, solid comps. Appraiser will do whatever they want with them, but sometimes it can have an impact on it. Um, let's see, drive copy of a driver's license,
Okay.
usually important because your title company is going to ask for it. Um, I'm trying to think of what else there really is. I mean, that's probably 90% of everything that's got to get collected right there.
So it's not even that much stuff. It's
No, not
okay.
usually.
So
No,
it would be a problem if someone couldn't get all that together. I
yeah,
think there's bigger problems going on.
yeah, that's exactly it.
Right.
One of the things that I usually encourage people to do, it's like go to Office Max, right? If you're old school, go to
Yep.
Office Max and go get a 3-ring binder and put all the stuff in the 3-ring binder.
Yes.
Right? If you're a little bit more tech savvy, scan it all in, make a single folder in Google Drive, Dropbox. Like I don't care where you put it, but go put all the docs that you need for every single closing in one folder.
Mm-hmm.
And then it's super easy. So as soon as you apply for a loan anywhere, you just grab the contents of the folder and you just ship it.
Yep.
And bam, we have 80, 90% of what we need right up front. Well, now underwriting just got so much smoother and faster. We as a company can move faster because we get stuck, right? If we can't collect the right data, we can't move the loan. And so, by being organized and prepared like that, you really accelerate the process considerably.
Got it. Okay. Um, so a lot of what we've talked about today has been on the fix and flip side and then the transactional side for wholesalers. Are you doing any lending for the BRRR investors that are more
Yeah,
the portfolio guys?
yeah,
You-
yeah.
Okay.
So we'll do both sides of BRRR, right? Because the
Yep.
front side of BRRR is really a flip.
Flip. Yep.
It's a flip that you're just not
Sure.
selling, right? You're just going to refinance. So a BRRR is really the same as a flip. It's a renovation type loan just to get that done. Do we have long-term financing solutions on the back end? Of course we do. Depending on where we can put the loan, because every deal is a little different and not every loan fits in every single lender's box that they want to lend on.
Sure.
So sometimes we have to do, a rehab type loan to get the thing done, get it renovated, get it prepped and ready to go. And then we have to do a new, say, 30-year fixed loan, usually referred to as the DSCR loans that are out there now. Sometimes we can actually roll, depending on where I can place the capital behind the scenes. Some lenders will allow me to actually convert from that renovations loan into a 30-year fixed product without incurring a lot of the extra fees that you would get. There's still some fees to do the conversion, but it's a lot less expensive when I can do it. Now, again, it doesn't work for every single scenario, but every chance we get that we can set one up that way, it cuts our commission, but that isn't the main motivator, right? The
Right.
main motivator is let's get the deals done because that's how we work together. And it's almost like the Walmart thing, right? We'll make it up in volume if we can
Sure.
just work together for a long time.
And from that lender's perspective, is it they already have the deal acquired and they already have their interest in their pipeline, and is their thinking there that it's a stable deal and they're happy to convert it, or what's their thinking on not getting the restructuring and the extra points and the extra fees? Why would they do that?
So in general, we'll forget about the fact that we can convert it in house and think
Sure.
about it just from like what happens in the regular world for a
Mhm.
second. When you have a loan with a lender, doing any kind of refi is easier than doing a purchase in every single scenario. Why? Because there's already a loan in place.
Sure.
Because what goes on inside of a lender's head is the risk is lower for me to refinance this because someone else has already gone through and done a ton of the due diligence and determined this is a smoking hot deal. So all they're really trying to do is buy the loan and get it into their portfolio.
Got it.
So, and most people probably don't even notice it, but yet I know everybody knows this. Like, go to the bank and say, "Hey, I'd like to buy a flip," and then look at how deep they're going to dig into your world to give that to you. And then when you get done with the renovations and you go back to the same bank and you say, "I'd like to refinance," look at what they don't ask you for the second time,
Sure.
right? So it's the same thing, except now the lender is at a much lower risk because they're refinancing their own loan.
Got it.
Right? And so that's what's happening. They're not trying to buy someone else's loan. They're just restructuring their own
Got
and
it.
converting because it's new paperwork, right? Because it's not a short-term loan, it's long-term. So, but it's a lot less work. It's a lot easier. It's a lot less risk. And so they can cut the costs and they can cut the timelines.
Got it. Okay. So let's go, Jeff, 15 years ago, 5 years into your real estate investing career.
Mhm.
What are things you wish you knew then that you know now about borrowing hard money to flip properties?
Wow. So 15 years ago, um,
Oh shit, 15 years ago. You're right in it. You're
yeah,
right in the mix.
yeah, I was right in the middle of,
Right.
everything going to crazy town.
Yeah.
Um, but 15 years ago, it really didn't matter that there was, a crisis going on because there were still people who had cash that wanted to invest in real estate. And there were the people that wanted that were people that understood that things were now on sale. Right. And so it was actually easier back then. And the truth is, back in 2008, 9, 10, 11, even 12, we could be really, really stupid sloppy, almost as sloppy as they were that got, to the point where they got us in trouble in the first place. Because, corrections don't happen back to back that close. But back in 2005, like if you bought, or 2008, if you bought a property, you couldn't help but make money on it. Like even if you did a really crappy renovation on it, you couldn't help but make money. Same as before the crash. And the reason now it worked even better was because all the prices were lower. And so it was so much easier back then. Really, what's happened since 2008 to today has been an evolution of the marketplace. And most of the things that I know now today, unfortunately, are from hard lessons learned, because the reality is people are people.
Sure.
The majority of people are good, honest people, right? But unfortunately, not all good people are good to do business with. And that's just a harsh reality of life. And so over time, I've had to alter paperwork. I've had to upgrade things because of deals that went sideways, and not all just my deals, because I have a lot of friends who are also lenders as well. And I like to learn from their mistakes too. And so you just get forced into putting things into the paperwork, because if you don't, someone will take advantage of it and they will steal you blind. I'm actually working on a deal right now. I'm not part of the deal, I'm just helping with it. Someone who had some cash decided to do a private loan. They didn't really know what they were doing. The odds are there's no one that can save this deal. And the odds are that the person that they lent the money to is actually going to pocket all of their retirement money. That's the thing that most borrowers don't understand, right? So, like, the biggest lesson I've learned across the whole gamut of everything is that borrowers don't plan to fail. They just don't. And it's a real easy reason to why. Because it's not that they don't care. It's not that they don't know deep down something could go wrong. But the reason that they don't think about it is because when you put a deal under contract, you believe it's going to work. If you believed it was going to fail, you wouldn't put it under contract,
Right.
right? And
Yep.
that's just the simple truth of it. So, because everybody thinks that the deal they got is so good, they never think about what's going to go wrong. So, my biggest lesson across all this stuff is I actually am trying to assume that every single deal that's brought to me is going to fail every single time. And the reason that I like to be a resource, and the reason that I like to bring advice and I like to teach and stuff, is because my job is to take every single deal from this position of it's going to fail to what can we do to help make it bulletproof?
Got
How
it.
can I help the borrower structure this thing, run it, manage it, and have the right people involved, so that while you can't guarantee success, every positive thing that we can tweak and enhance in the thing improves it, right?
Yep.
Unfortunately, paperwork behind the scenes, which is why, like, borrowers today, they walk into closings and our paperwork stacks are like monstrous. I mean, it's like, you feel like you're buying a house, like you're giving away your life, right? And it's the unfortunate not so good people that have forced the giant mounds of paperwork that we have to produce. But if we can structure the deals right and we can really position things with borrowers correctly, 99% of what's in the paperwork doesn't matter,
Got it.
because it's never used.
What now you mentioned something earlier that your people don't think about deals going bad or they wouldn't have gone under contract. So of the deals, the hard money deals that don't work, are you typically seeing a sort of blind arrogance and confidence, or are you seeing shit hitting the fan when you open up a wall and you just have unexpected expenses, or a mixture of both? What are you typically seeing as to why a deal falls apart?
It's actually more the first one. It's mostly blind arrogance,
Okay.
unintentional. Nobody means to do it. Nobody
Yeah.
means to have things go bad. But it's kind of like when you're up. I don't know. Nobody watches late night TV like this anymore. But you're on the internet, you're on Facebook, and this ad pops up in your stream, and for whatever reason, it catches your eye, and it promises you the sun, moon, and stars, and it makes it sound like it's just so easy, and I there's nothing in the world I can do wrong. I'm just going to go make $1 million. It's the same thing when we get sucked into that get rich quick scheme.
Yep.
It doesn't matter. We could be 5 years into the business and know that there's a chance of failure. But you know what? When we see a deal that we believe the numbers just work, we'll put it under contract. A really good lender will help you see the truth. There are lenders out there that don't care, and they will just go, well, you know what? It fits the box. Here's your check.
Got it.
And then the deal goes bad, and their very first response to the deal going bad is, great, we'll take it back. And they'll just foreclose. And if they foreclose, you now have a foreclosure on your record. And that's not good for anybody. My first reaction is never to foreclose. That doesn't
Right.
mean that we haven't had to, but that's my last resort is foreclosure. There's several other things that we can do to help save a deal, uh, rather than foreclosing and hurting people.
Got it. Okay. Shit. Well, we can't end on that. We can't end on a negative note. Give me something. Give me something positive in the hard money lending space. Let's end on a positive story, positive case study. Think in the last 60 days of a deal that went through. Give me a good case study to walk through.
Yeah, I don't have a great one off the top of my head, but I can just give you a typical deal that
Sure.
comes through. The average deal for us is usually in the 200,000 range now,
Yep.
maybe 250. So if somebody comes through with a $250,000 deal, let's just say it's worth 400. Okay, that's got a good spread on it, right? The $150,000 is a good spread. The LTV is well below 70%. This is pretty much a solid deal. If somebody has good experience, we want to close that thing, right? And so I think, I don't know, last week we closed several loans, but when they fall in that, I don't know, just what I'm going to call that sweet spot, right?
Sure.
Um, mid the mid-tier homes, right? Really where the median price range of any town, if you can get a deal where your after repair value flops close, give or take, to where that median is, it's super easy to close those as long as you're buying it right.
Got it.
Because those are the deals that everybody loves to fund, because that's the house that everybody wants to buy, right? Does everybody want to buy a $2 million house? No, they don't.
Hmm.
Right? When you look at the buying pool, there's just not that many people that can afford it, right?
Sure.
Can you make more money on a $2 million flip? Of course you can, but it comes at a really, really high risk, because this isn't HGTV,
Sure.
right? But if we go down that path of getting close to median, maybe a little above, man, those things are easy to get funded. They're easy to run. They're easy to manage. Generally speaking, too, in that price range, you don't end up with major renovations, where you have to start tearing out walls and start doing all kinds of structural things.
Sure.
You're not usually running into mold or any of the other bad stuff. Most of them are paint and carpet. And if you do have to do some renovations, it's like, well, we got to put in a new kitchen. We just got to, but it's just cosmetic upgrades.
Got it.
Putting in a new kitchen to me is so common now. That's just an upgrade. That's not renovations really anymore, or full gut stuff.
Got it.
Right? That stuff gets easy to fund, and that's the stuff I love working on deals with people on, and helping them get those things across the line.
Awesome. All right, Jeff, that's it for today. If anyone wants to speak with Jeff, I'll put a link in the description below. Thank you very much for your time today, Jeff.
Yeah, you're welcome.